Good to go. Welcome to Epic Street. Again, I want to thank everyone at Epic Street for making this event possible. They conduct some outstanding events. I've done so for how many years? You guys tell me. How long has Epic Street been around? I know I've done some up through last year. I did almost actually 2 per week, twice per week webinars from like August of last year through the end of last year. Then my coaching schedule changed at Epic Boot Camp. Took a bit of a hiatus, and now I'm back. Been back for something like a few weeks now. Glad to be back. Glad to have a chance to chat with everyone here at Epic Street and everyone here that attends the events. So again, they do a fine job. I really appreciate their rolling out the welcome mat and giving me a regular time slot here each week. Well, first, let's start with a disclaimer. Let me remind you the purpose of this event is education. I'm not going to provide specific trade alerts or recommendations, but we'll take a look back at what has transpired this week, especially amongst the major currency pairs, focusing probably particularly on the Euro USD. And I'll certainly take a few moments, as I often do, to take a look ahead at what's going to come in the days and perhaps even weeks ahead. And we'll talk a bit about what's the so-called fundies, fundamentals, news and such that have seemed to have affected the market of late, and news or potential forthcoming news that could affect the market in the days ahead. 12 years? Has it been 12 years, Maud? Wow. George, am I doing Asia today? No. I believe the Chief Currency Coach Will McDonald will probably be conducting a free session in our free room at Epic Boot Camp. But if you're talking about a regular Asian session, no, not a regular Asian session. We do offer some Asian coverage in the free room. Anyway, I want to get started with this event. Yeah, this has been quite a week for the euro, wouldn't you say? Let's take a look at the euro charts here. I'm going to pick the right time frame here to cover what I want to cover. This is pretty good. Yeah, I'll stick with this. We spoke on Monday in my New York morning session coverage in our training room, New York training room at Epic Boot Camp. We talked about a long at 1.23, the psychological level during the New York morning session. That worked out, But what was most interesting about this week's price action in terms of real opportunities and in terms of the news that really moved the market, it was let's face it, it was Tuesday and yesterday. Tuesday during the London and to some degree during the New York morning session, and then yesterday, particularly after London closed, that has really defined this trading week. And you know what? I'm actually going to. I'm trying to think how to do this. I want to start not with a review of the news that moved the candles here, so to speak, but I'm going to take a look back at something here. I created a graphic. It was an hourly chart for the euro with some annotations on it. Let me show you that. Hang on. Yeah, I want to show you this graphic because this is kind of where this is kind of the origins, the genesis, if you will, of the recent euro rally. The euro hit its low in late July, at least the low for the year thus far on the euro in late July. And I noticed that you may have noticed that Spanish bond yield, specifically the Spanish 10-year yield, peaked just north of 7.6% in late July. It was the next day on Wednesday the 25th that a key member of the ECB, of the European Central Bank, namely Nowotny, the Austrian Central Bank head, he made a comment, rather somewhat subtle comment, nevertheless, it put the euro on a bid that day. Made a comment about the Permanent Rescue Fund, the ESM. See, let me step back a minute. There's been plenty of speculation by traders, investors, economists, analysts, you name it, media members about what would constitute a significant solution. Maybe not a fix for Europe, but at least a notable solution that will buy Europe time. allow countries like a Spain, like an Italy, to incorporate some structural reforms and yada, yada, yada. So what will it buy Europe time to, especially the southern European countries, to help repair their economies and make them more competitive, and to help Europe get these several European economies get back on their feet. One solution has been floated around, that's been pondered, has been given the European Stability Mechanism, which is Europe's Permanent Rescue Fund. That Permanent Rescue Fund established in the wake of the initial sovereign debt crisis in Greece back in 2010. Specifically, it was May of 2010 that the plans for the Permanent Rescue Fund, the ESM, were put in place. By the way, that Permanent Rescue Fund has not yet been approved by Germany. The German Bundestag is scheduled to vote on that on September 12th. I will probably mention that date again here later in this webinar. Maybe back on task here. So one of the I just mentioned the spike in Spanish bond yields. As markets get spooked about the prospect of whether or not, say, Greece or earlier, now Spain more recently, whether or not Spain can service its government debt, we've seen pressure on Spanish government bonds. Price pressure means yields rising. Yields rising means Spain, it becomes prohibitively expensive for Spain to service its government debt, and it gets to the point where a country like Spain might eventually, and there's some chatter about that today, in fact, Spain might eventually request a formal financial bailout. Well, one of the solutions that, I haven't explained it fully, one of the solutions that's been espoused by some has been give the ESM, the Permanent Rescue Fund for Europe, a banking license. That way the ESM could borrow from the European Central Bank, and the ESM could in turn acquire through some means government bonds and help stabilize the bond markets in the likes of, say, Spain or perhaps even Italy. So that's one reason for the jump in the euro that day on July 25th, the Wednesday. In response to the Nowotny comment was, maybe there's maybe at least some members of the European Central Bank, and perhaps eventually maybe even Germany would be open to giving the ESM a banking license. So perhaps a little bit of euro short covering, perhaps a bit of hope there. The next day, the next day, July 26th, it would be the Thursday, July 26th. That would be what many are referring to as Draghi's "Believe Me, It Will Be Enough" speech, or some call it the "Believe Me" speech. Pretty sharp words, pretty notable language from a central banker. Almost maybe a bit defensive. A bit defensive there, perhaps, on the part of the ECB president. Draghi was making a reference to the premiums or excessive yields on government bonds in some of the southern peripheral European countries, particularly Spain. And he was essentially trying to build a case during that speech at an investor conference in London, trying to build a case for the ECB to step in and buy bonds under the confines of its mandate, which is price stability. See, there's been plenty of objections, particularly by the Germans, from the Germans, about the ECB, if it were to buy bonds, it would be a step outside of its original mandate. Well, Draghi was essentially trying to make the case, if unusually or extremely high bond yields didn't allow the so-called transmission mechanism of monetary policy to work properly, then it might be within the ECB's mandate to bring down bond yields to facilitate essentially the rate cuts that they've then recently to work their way through the banking system throughout Europe. And that's maybe not be the best explanation, but I'm trying to paraphrase. In other words, Draghi was trying to build a case for that bond purchases that such a move would actually fall within ECB's mandate. So the euro jumps that day, and again, you could chalk it up to some euro bulls. I would say most likely that was some short covering, a sort of a short squeeze on the euro on those comments that made out by Draghi. So a couple things I want to point out here. Number one, the market has been very, very headline driven. Comments by European officials in Europe, in some cases Draghi, in other cases you have sometimes a comment about something Merkel has said or something Merkel maybe is thinking. Stuff like this have moved the euro, in my opinion, very, very often, not just in the past few weeks, but in the past few months, almost actually looking back like a good 2 years now. Europe is or has been driving the bus. Now, mostly. Yeah, what the Federal Reserve may or may not do is a factor as well, and we'll talk about that in a minute. But the point I want to make was that the market is certainly sensitive to the situation in Europe and how that might unfold. Is there going to be some sort of a bazooka solution delivered by the likes of the ECB, or are the Europeans going to come with something different? Whatever. The market's looking for something to happen out of Europe. And in the past few weeks, there's been some building hopes now about the ECB potentially doing something. So this takes us back to our hourly chart for the euro. I'm looking at this move, and it may seem so. I'm going to actually go to a 15-minute chart. And let me turn off the auto scroll so I can go back in time. If you've been watching any of my recent New York session video reviews, I've been referring to a 1.2375, 75 area, which I want to note with the horizontal red line near the top of this chart. It's interesting because we had several traders, several members at FX Bootcamp in our London session that day looking to short this pair, and rightfully so. If you look at I can show it separately if you haven't seen it yet, but if you look on your euro charts, an hourly chart, 4-hour chart, the 2375 area has been important to the euro on several occasions over the past several weeks. And at the open of Tuesday's London session, there was the euro parked right at prospective resistance. Well, I told the live class in my New York room hours later, and this would have been, give me my time right here. It would have been about here. Actually, no, it was farther up than that, I believe. It was a little bit later than this. Let me just go chart them forward in time. Yeah, it was right in here. The euro was about 24.20. I told the live class at the very beginning of my session that if this was one time at the start of that days of Tuesday's London session, I was the most bullish. I had my strongest bias with regards to the euro. In this case, it was a bullish bias. The strongest bias I had had on the euro ever since that day on July 26th that Draghi made his "Believe Me" speech. Again, that London session open, the strongest bias I'd have had in any direction. In this case, it was bullish. Strongest bias I've had towards the euro since the day of the Draghi speech. Why? Well, it was actually an article in the written by Ambrose Evans Pritchard at London's Telegraph, and the story was about a member of the European Central Bank. In this case, another member. I mentioned the Nowotny earlier. Well, in this case, a very key member, a German member, handpicked. I believe the name is. If I'm mispronouncing this, I'm probably going to make some people laugh. But it looks like the name is pronounced Asmussen, but I could be wrong about that. Asmussen. A key German member of the European Central Bank Governing Council, handpicked by Merkel, the German Chancellor. This guy apparently, according to the story reported by Ambrose Evans Pritchard at the London Telegraph, published before the Asian Open on Tuesday. Apparently, this German on the ECB, is now supportive of some sort of bond buying program, which has been recently espoused by Draghi at the ECB. Now that's significant because it's the Germans, especially the Bundesbank, especially a number of other German officials, Merkel for one. The Germans up until that point, for the most part, had appeared to objected to bond buying. Why? Well, the Germans are, as many of you know, more than a bit fearful about future inflation. Germany dealt with a nasty bout of hyperinflation back in the 1920s. They don't want to repeat that. So many of you know what happened after Germany dealt with hyperinflation and some tough economic times following that. What else was I going to say? But in addition to the concerns about inflation, the Germans, and rightfully so, don't want to induce any sort of moral hazard situation. Moral hazard meaning that the Germans don't want to give the Southern Europeans, like the Spanish, for example, so much help that there won't be any incentive to reform their economies and improve their government budgets, to improve the government finances. So, and there's some other reasons, but those are some of the main reasons why the Germans have objected up to this point to bond purchases by the European Central Bank. They've also made the argument, as I mentioned earlier, about it's not within the ECB. In their views, it's not been within the ECB's mandate. So that story, now who knows? It may be a false story, although the reporter does have a solid reputation as being fairly reliable in terms of its accuracy of the stories. So that story is notable in that it's a sign that perhaps the Germans are bending a bit in their view towards the ECB as in terms of their intervention in government bond markets. And a lot of the recent speculations have been around, well, maybe the ECB caps bond yields, puts a limit, maybe 6% or whatever on Spanish government bonds. I personally think that's going to be a bit of a challenge because if the ECB is going to cap bond yields in Europe, what number do you pick for each country? What's the basis for deriving that number? If there's different numbers for different countries, why? And how do you defend that? So, but I'm getting too much in the particulars right now. So, the point I wanted to make was there was certainly a case that day for looking to buy the euro on a dip. And let me activate the drawing tool. And there was the long retest of the Asian session high. There were some other factors there, but that was certainly the base case. Along around 23.60, 23.65. It was up the rest of the day for the euro. So yeah. Try to deactivate this drawing tool. Shoot. You see, euro went up and up that day. Now it brought us to yesterday. Yesterday it was a long at 24.40 we were talking about. Why 24.40? Well, I can show you. And actually, part of the explanation behind the basis for the long 24.40 yesterday also is a part of the case for the long today. So let me adjust this chart. Johannes, I see your comment. I'll get to that in a moment. Good question, by the way. Good question. Now, Johannes, was your comment relative to the long on Tuesday in early London session trading? If so, I mean, you're right. It was merely speculation that would be important. Here's what I've noticed though about this is about price action by session. I've seen a number of stories over time, not just the one on Tuesday, but a number of stories over time where the market seems to ignore the story. It's Asian session, in my experience, my observation, doesn't react much to stories about Europe. Right or wrong, whether it makes sense or not, the Asian session traders just don't do anything with that. I've seen, I've even seen this sort of thing happen with regards to China news. Asian market just kind of does its own thing, generally speaking. I've seen plenty of days, maybe not so many recently, but in an example of, say, China news, I remember days like a year or two ago where China news would seem to dictate the market, but there would be no definitive reaction to it until London session got going. I mean, if you look at the historical volatility, actually, now I probably have a chart for that here somewhere. Give me a minute while I dig that up. I've got a flash drive here on this PC, which, shoot, maybe it's not on this PC. Actually, I've got an old one. Maybe this works. Yeah, I've got an old one here, which it pertains to analysis. Actually, no, this is current. This is current. Sorry. I don't know if this will fully answer your question, but here's been this has been the norm, and I've done a recent analysis which I don't show. This pertains to price action in the first quarter of this year, much of the fourth quarter of this year. And the point I'm making is this: right or wrong, I mean, you can argue what Asian session traders should or shouldn't do, but the euro USD just does not move. The euro does not move much during the Asian session. What this shows is the average size of a 15-minute candle, regardless of direction, whether it's green or whether it's red. The average size of a 15-minute candle, those are the black dots that represent the average size. The gray bars represent the 95% interval, which is a quant thing, which I won't bother you with right now. I don't have time to explain that. I can explain it later if anyone has interest in. Maybe you email me about that, and I can explain it further and send you even a copy of this graphic. But essentially what this says is that the candles are not very big. The Euro-USD candles are not very big during the Asian session. And the action when it comes to the Euro-USD is during the London and particularly the New York morning sessions. That's where the action is. And so Andy kind of makes a comment about the Asian central banks not fully in sync. Yeah, that's certainly a notable part of the story. Absolutely. So Johannes, that maybe Andy's explanation is one of the best, but from an empirical perspective, in terms of the historical data, in terms of the history of how the euro has moved and when it moves, I mean, this to me tells part of the story. Maybe it's mainly for the reason that Andy cited. Maybe it's for other different reasons. But the Asian market, the Asian trading session, has not shown a history of responding to news events, especially as it relates to Europe. The most action we've seen during the Asian session, there are some exceptions. Don't get me wrong, but the most price action we've seen during the Asian session on a Euro USD, as in response to we've seen some notable moves. As we've seen some major announcements in recent weeks in response to, I recall the one at the end of June. The euro spiked higher, saw a notable spike higher near the end of June during the Asian session when the European leaders meeting in Brussels came up with some sort of agreement. I forget exactly the context here, but on that day, on that Asian session, the euro saw a notable spike. But other than that, it's very rare for the Euro USD, for example, to respond to an Asian session. And Johannes, I would only add this: based on my personal research, based on my reading countless stories, I've seen virtually up until the news story on Tuesday, I've seen nothing from some notable German leaders that even suggested support of ECB bond buying. Perhaps a hint of a loosening by Merkel at times, but nothing that very explicit. And Johannes, if you can show me anything, in fact, here, email. You should email me. I'm not saying you should, but you can. Hang on a minute, let me post this. And this goes to anyone, by the way. If any one of you can identify any significant expression of support of bond buying by a notable German official before that news story on Tuesday, show it to me. I'm not issuing that as a challenge. I'm not trying to defy any implications of like criticism that Johannes said. I'm really an open book here. Please tell me, show me that there was a clue before that at least some major German official has expressed some openness to bond buying by the ECB. I haven't seen it. I don't catch everything, though. I totally admit I don't catch everything. But from what I have read, comments by the likes of the German finance minister, from Merkel, from the head of the Bundesbank there, officials like that, I've seen or heard nothing from the Germans which even began to show an openness towards bond buying by the ECB. So again, my perception, that's one of the first. And now is the ECB Governing Council guy from Germany, is he the most? He may not be the the one you really want to hear from in terms of openness to bond buying. But it's a start, and this is what markets do. The markets get a hint of, say, more German willingness to buy bonds, and it'll react. And I'm telling you, this has been an issue for a long time. The issue being German opposition to bond buying, and right or wrong, it's been speculated for some time that the ECB buying bonds would be a big bazooka type of meaningful solution that would shore up the Eurozone and at least help buy the Eurozone time. Well, and Johannes, you're right. I hinted at that a little earlier, that Merkel's perhaps loosened up a little bit, I think is the way I've said it. So true. Here's what else I would add. Well, let me go, Johannes. By the way, I appreciate your conversation here. Appreciate your comments here. Let me add this. I'm going back to that graphic that I showed earlier, and that was just showing about 1 week of price action. Where is that graphic again? Sorry, I gotta find it. I've got all kinds of stuff on this flash drive that's on this PC. Here it is. Yeah, I mentioned in the Watney comment that Wednesday, July 25th. I mentioned the Draghi comment. There were some other stories that next day, Friday, July 27th. Maybe it's coincidence, but I mean, I saw the charts, I saw the price action, I saw the timing of the comments. I found it uncanny. It was just uncanny how things that weren't even new. I mean, the comment that day, Friday, July 27th, about apparently Merkel in Holland, the German Chancellor Merkel and the French President said they will do anything to protect the Eurozone. I mean, there was a notable rise in the euro during that New York morning session that day in response to when that comment hit the wires, hit the news wires. Now, was there anything new? Absolutely not. That was nothing new. Nothing new. And even reports earlier that day about the ECB supposedly buying bonds. But what I still find uncanny is that when reports like that, when news like that hit the news wires, you saw an almost immediate reaction to the euro during those sessions. It was the London and New York morning sessions. That's when the market tends to respond to news events out of Europe. So again, your point about was it priced in? Perhaps. And actually, the question I ask, and we'll finish the topic, move on. The question I ask after that is that if it wasn't that, then was it something else? Now, it's always a guessing, almost always a guessing game as to exactly what moves any currency pair at any time. Perhaps the jump in the euro that day was more attributable to just, hey, the stops were triggered. Maybe some hedge fund jumped in, bought the euro, bought it enough to push it above 23.75 and stops and triggers stuff. But again, I find it uncanny how that jump in the euro that day, to where the euro made it jumped above its early August highs, which I'm going to get to in here in a moment. Why did it occur that day versus any other day? Let me adjust this chart again. Okay, yeah, here's the point I want to make here. Back to a 4-hour chart. August 5th and 6th highs right there. During the rise on Tuesday, again, debates as to what caused that rise, if anything. But nevertheless, the euro rose. At the U.S. equity market open yesterday, the euro was back at the earlier August highs, and up we went. The point I made yesterday, and the same point I made today, was this. Let me zoom out on this chart a bit. I said, look at the notable moves in the euro especially the notable rallies in the euro, and what's happened on the next day during the New York morning session. Again, I'm just showing you what it is. You guys can make of it whatever you choose. There's the Draghi comment. There's the Draghi, believe me, it will be enough speech, or the response to that. The next day, during the New York morning session, the euro rose. Made a new, multi-day, multi-week high. Great. The next week, a Friday, we got that sharp euro sell-off during the ECB press conference. The market seemingly disappointed about no immediate policy move by the ECB. Market rethinks it, recovers at least moderately during that next day's Asian and London sessions. We get the better than expected NFP number that first Friday of the month. The euro rises further. The next trading day, which is a Monday, it's a subtle move and perhaps just totally arbitrary. But, and I remember talking about this. We talked about this in the live class at Epics Bootcamp. We talked about the prospect of a euro long at 23.75. That day, the 23.75 level will have a notable effect on price action. We talked about the prospect of a euro long. The euro did manage to rise. I mean, not make new highs, but it did rise during that New York morning session. Okay, great. So there's two occasions. Notable euro moves the prior day, followed by at least some extension during the New York morning session. That brings us to yesterday. Yesterday, you get the notable euro rise. Euro at the U.S. equity market open. Retest the August 5th and 6th highs. Euro was up during yesterday's New York morning session. Today, we talked about support. First of all, there's the post-FOMC minutes high. Some lows here and here. U.S. equity market open about right there. And it took a while to get going, but finally, the euro rose yet again. I'll let you decide if it's just purely arbitrary or not. But that's one of the things that as a quant and as a technical analyst, as a trader, I look for. I look for patterns. I mean that tomorrow it could be a totally different picture. But the euro has shown a pattern there. Andy, I agree with that. Andy talks about the nature of the survival of the euro. I think it's one of the major U.S. banks. I think it's Citibank, or was it Citigroup? Posted something yesterday about their speculation about a Greek exit. They see a 90% chance of Greece leaving the eurozone, and it could be as soon as next month or October. So some of that's being priced in right now. Like they're arguing some of that has already been priced in. And folks, I haven't really begun to talk about the bigger picture, the long-term scenario here. Here's the point I'm making. This is especially in response to Johannes' comment, which again I really appreciate. Whether I like it or not, whether any of you like it or not, this is a headline-driven market. This is a headline-driven market. This is a headline-driven market. It's arguably a schizophrenic market, too nervous, too jittery. But I've seen it often enough to be fully confident in telling you this. The euro has been just so sensitive to even seemingly meaningless things, even comments by officials that on covering themes that have already been discussed. I mean, I've seen the price action on a short-term time frame. A little to no volatility, comment made, hits news wires, boom, the euro comes alive. May not be much on a given day, but it's what happens. That's what happens. And again, the Tuesday was an exception because you had the news story which was published. Was published at a time when the market does little to nothing with the euro. But a very sensitive market, nevertheless. So what now? So that's been the price action for this week. We had last week where we had some periods of yen weakness, perhaps due to in part to rising bond yields in major developed economies. But you notice the bond markets lately? You notice the Treasury market? Treasury yields have dropped notably. We were at a little more than a week ago. We were almost 1.86% on the U.S. 10-year. I haven't checked it lately, but last I checked, and I can check it here in a moment. I got my Bloomberg Market Monitor on my other PCs. U.S. 10-year. Yeah, we're still sub 1.70. That's a notable drop in the U.S. 10-year. Perhaps is it still lingering concerns about either Europe? Is it concerns about China? Anyone sees China's PMI number? Perhaps is it more renewed speculation about more QE by the Fed, which I'll talk about in a minute. For starters, let's take a look at the latest China PMI data. Actually, before I let me catch up on some comments and questions here. Yeah, I see the ECB denied Der Spiegel's report. Well, you got to admit, how often have you seen that? Not just the ECB, but a lot of central banks. You see a rumor, then it's denied, and then perhaps. I still cannot forget. This was in May of 2010. I believe it was Trichet. Well, I know it was Trichet. Jean-Claude Trichet was the head of the central bank at the time. Trichet was adamant on a Thursday or Friday during a speech that ECB would never be in a bond buying business in any way, shape, or form. Sterilized or unsterilized bond purchases, ECB wouldn't do it. 2 days later, bingo. ECB has launched a new bond buying program. Maybe it wasn't 2 days later, but the point is that don't believe everything you see and hear from a central banker or even from the media. The point again I'm trying to make is that there's a whole mix of stories out of Europe. You hear one thing from the Germans, you hear another thing from the French, maybe another thing from the Spanish. The media speculating things, the economists speculating things. The main point I'm trying to make is that the market is reacting right or wrong to not everyone, but a lot of these stories, a lot of these comments, a lot of these news events. The market's trying to piece together as best it can, maybe not so good, what's makes some sense out of how are things going to play out in Europe. Right now, right or wrong, it seems the market is expecting some form of intervention in the bond market, some notable policy move by the European Central Bank. That, in my mind, the market has no doubt that the ECB is going to do something, which I can touch before I get to the China PMI numbers and potentially its implications for the Australian dollar. A notable date to put on your calendar, actually, and of course the market won't be open at this time, but given the speculation about the ECB doing something, who would provide a new clue, or where would a new clue come from in terms of next ECB policy meeting? Well, how about a Draghi speech? Anyone know when Draghi is speaking next? There's ECB President Draghi's next speech. When is it? And by the way, if you don't know it, you should know it. You should know it. I'm not trying to sound mean. I'm just saying, as a trader, you should be keenly aware of key events like this. I'll wait an answer while I drink a little green tea, which I haven't even taken a sip of yet. Sanjay, it's negative euro confidence and positive home sales. It's not what the market's reacting to. I mean, you make very valid points about those news. What's right or wrong? What's moving the market the most, folks? It's speculation about the future of Europe. I mean, the market knows that confidence is sour in Europe. That's not what I mean. That was priced in arguably weeks, months ago. What the market's focused on right now is, how are things going to play out in Europe? Who can affect how things are going to play out in Europe? Politicians and the central bank. That's it, folks. That's it. Some of these second and third tier news reports, they can affect some volatility on the market, and maybe for a few minutes or an hour or so. But the real deal, in my opinion, in terms of what's going to prompt the major moves, like the moves we saw this week, for example, on Tuesday, it could be speculation. I mean, meaning that the market can get it wrong. I mean, for example, the market totally got it wrong. Where's the 4-hour chart here? Totally got it wrong that first Thursday of the month. Market totally unfairly almost punished the euro that day. With closer inspection, I mean, Draghi, and he did offer up something for the market. Now, he didn't offer it up quickly, as quick as the market won, but that's the market for you, I guess. By the way, before I go on to, I never got to answer my question, by the way. Next Draghi speech, when is it? Anyone? Okay. Jackson Hole, Wyoming. That's another. That's a location that should be familiar to you eventually. Each year, the Kansas City Fed hosts a conference for central bankers in late August. The next conference is coming up. I believe it starts next Thursday. It's going to run through Friday and Saturday. Next Friday, the Federal Reserve Chairman Bernanke is scheduled to deliver a speech there. And let me show you the relevance of that speech by Bernanke, and then we'll get to. I know I'm jumping around. Sorry about that. For anyone who wants to know the origin of my orange trend line, there it is. High there. Perhaps some near-term highs and lows here. It's one of those so-called median lines. If you go back to a daily chart, perhaps a 4-hour chart, that could be at least part of the reason why the euro has, although risen during today's New York morning session, has stalled to some degree. Also the top of the channel play here. We reached the daily M4 as well, so again, just highlighting some technicals there. So Jackson Hole. Why would Jackson Hole be relevant? Well, I've got a graphic to show you here. And I haven't forgotten about the China data, but I want to follow through with this. Even if I ignore the China data, I still want to get to what I feel is most important in the coming days and weeks, which is central bankers or prospective central bank policy. Is this the one I want? Yes, this is it. This is the one I want. Thank you, Ani. That's correct. Some of you may have seen a graphic like this before. This is a weekly candlestick chart showing price action on the S&P 500 index and the announcement, either the announcement of or the start of quantitative easing programs by the Federal Reserve. The so-called QE1 program was originally announced in late November of 2008, weeks after the bankruptcy of Lehman Brothers. Eventually, it stabilized equities, and equities rose. Notice how you get a bit of a dip starting this week after the end of QE1. And Bernanke, and this would be in late August of 2010, Bernanke offered up during a speech at Jackson Hole some notable clues about another quantitative easing program. Notice how the S&P rose from almost that day forward, rose into the announcement of a QE2. After QE2 ends, S&P drops. And then in September of last year, the Fed announces what's now called Operation Twist, whereby it sells shorter-term treasuries in its holdings and exchanges those for longer-term treasuries, an effort to bring down longer-term yields. Longer-term yields basis for a lot of loans and such. And again, just an effort without affecting the Fed's overall balance sheet level, an effort to stimulate the U.S. economy. Well, now, what's interesting about this, some think that one of the Fed's main intents is to induce a sort of wealth effect, whereby if the Fed does a policy move like quantitative easing, that eventually pushes more money into equities. that it can induce a sort of wealth effect. If U.S. consumers feel wealthier because their 401k accounts levels are higher, their balances are higher in their 401k accounts and their stock investments, and that U.S. consumers might eventually feel more inclined to spend. Now, we haven't seen much evidence of that yet, but nevertheless, that's the logic. That's the logic that some like to apply to when it comes to the Fed, at least part of the Fed's justification for more QE. Now, what's interesting about the FOMC minutes that were released after yesterday's London close is that look where the S&P is. Unlike the dip before QE, of course, we got a huge dip before QE1, a more modest dip before QE2, a dip before Operation Twist. Where's the dip? Where's the dip? We have no dip. In fact, the S&P, I believe, was just yesterday, made a fresh new 4.5-year high. And yet, did anyone notice the FOMC meeting minutes or some highlights from that? I've got a key quote from that from those minutes. Many members judge, I just don't suppose I put in the room there, many members judge that additional monetary accommodation would likely be warranted fairly soon unless economic information, blah, 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 blah. You can read the rest yourself. What's significant about that? Many members judged, that means several FOMC voting members judged, meaning that they've already decided that some sort of additional easing, perhaps QE3, is justified fairly soon, by the way. The term's fairly soon in and of itself. Strong words. I mean, that's like, what's the analogy? If QE3 or full quantitative easing were a gun, it's like the Federal Reserve has its finger on the trigger and is even starting to put a little pressure on the trigger. The Fed is ready to shoot. That's a logical interpretation of that statement. The Fed is poised and ready to pull the trigger. Especially when you consider that, unless income and information pointed to a substantial and sustainable strengthening in the pace of the economic recovery, where's that going to come from? What would they focus on? I have an idea. I don't know if any of you do. I'd say the labor market's the Fed's focus right now. Jobs, U.S. jobs. Another look at the one scenario that, or one measure that has been a notable clue to more easing by the Fed. Anybody familiar with the break-evens, 5-year break-evens? It's a measure of U.S. consumer expectations about inflation in the U.S. And I'm probably running short. I know I'm running short on time, so I'm not going to explain this in great detail, but look at the 5-year break-even rate. Extremely low. The market expecting deflation back in late 2008. The Fed announces QE1. Break-evens dip. Expectations of more disinflation. Bernanke hints at QE2 back in August of 2010. Another dip in the break-evens. Not quite as low as the dip before QE2, but nevertheless a dip. Operation Twist is announced. Look at break-evens right now. Last I checked, they were about 1.9%. Not exactly a sharp dip that has preceded prior quantitative easing programs. So I tell you, it's an interesting market. We don't have there's been no dip in equities. There's been no dip in the 5-year break-evens, and there's other measures, by the way, you can look at that show some relationship or some correlation, if you will, to quantitative easing program launches. Some of the measures of the U.S. economy don't look all that bad. Are they good? No. But are they terrible? No, they're not. So it makes you wonder what's on the Fed's mind. Because, again, those comments from the meeting minutes, although maybe they're a little bit stale, maybe they're a bit dated, I certainly can understand why the market thinks, right or wrong, that more QE is forthcoming or some form of additional easing is coming. Maybe it's a reduction in the interest paid on excess reserves. So here's the point I'm getting to, and I'll promise I'll catch up here on comments and questions. man, there's going to be a lot of focus. I think a lot of focus on the Jackson Hole speeches next week. Ani mentioned a few minutes ago the September 1st Jackson Hole speech. That's by ECB President Draghi. Given the introductory statement by Draghi at the ECB's last press conference, given his infamous "Believe Me" speech and at a conference in London late last month on July 26th. Right or wrong, the market expects the ECB is going to do something, perhaps even the Fed do something. If I had my druthers, if I were, I got to think there's more than a few members of the Fed that don't want to do anything. The Fed, if they have the druthers, they'd rather see the ECB do something, and then see Congress, hopefully sooner than later, but don't count on it. U.S. Congress do something, resolve the fiscal cliff situation and do some other things to help stimulate the U.S. economy, help reform the U.S. economy. Entitlement programs. I don't want to get into politics and stuff, but Bernanke has been very explicit about his desire for the Congress to step up right now. But perhaps one reason why the Fed's poised and ready to pull the trigger on more QE. What if things get ugly? What if things get ugly in Europe? What if Spain doesn't agree to a bail? What if Spain doesn't like the terms of any bond buying program by the ECB? What if Spain doesn't want to give up sovereignty? I don't know. What if Germany doesn't approve, at least in the near term, the rescue fund, the permanent rescue fund, the ESM? So looking ahead, I feel like the market's just going to, technicals will probably prevail for the next several days unless we get some unusual comments out of Europe or such. But I suspect that the focus from here moving forward is going to be Jackson Hole. Bernanke speech next Friday, perhaps some unique price action as the market either does some squares some positions or perhaps a little front running of the Bernanke Jackson Hole speech as we approach the end of next week. Again, the Draghi speech on Saturday will be closely watched, although the markets won't be open. And then if Draghi doesn't show much of his hand on Saturday, then the focus will, in terms of Europe, will immediately turn to the next Thursday and the ECB press conference. And then, of course, the next day, Friday, the jobs report. The jobs report, if Bernanke doesn't show us anything dramatically new on the Jackson Hole speech, then, or even if he does, the jobs report will either confirm or not the prospect of more QE, or could at least confirm that. Yeah, Andy, I see your comment about weakening the dollar. Let's face it, a weaker currency does help exports, although the U.S. isn't exactly an export power. We don't derive nearly as much GDP from our exports as do several other countries. But, what else does a weaker currency do? Doesn't a weak currency help make one's debts a little more affordable? I'm going to show you while I answer some other questions, I'm going to show you the latest China PMI number. Not so good. Lowest PMI number in several months for the China manufacturing sector. China manufacturing sector still shrinking. Some concern about China for sure. Philip says, should the Jerry's exit the euro? Philip, I would say, in general, any weaker country like Greece leaving the euro, the initial reaction could be negative, just a knee-jerk reaction by the market. But if I had to pick a direction, is it euro positive or euro negative? I'd say euro positive. You leave a stronger remaining eurozone. Now, there's going to be a fine line there. Because there's some rightfully some concerns I see about if Greece leaves and you get a sort of a contagion effect. There's an interesting article in The Economist recently about a memorandum, a fictional memorandum written by some of Merkel's key advisors to German Chancellor Merkel about what if scenarios with regards to the ultimate breakup or not of the eurozone. And one thing the article described, which I can see a case for, is if you're going to have a country depart the eurozone, why not just make it a group of countries? Just do it all in one fell swoop. And the article goes into a lot of details to why and the pros and cons of that. But it is an interesting, if nothing else, thought experiment. Because the concern is that if just one country, if just Greece leaves, for example, is there some sort of contagion effect? Are there bank runs in Spain or perhaps even Italy? There's something like that's a real possibility. How do you contain that? Gam says, do you think some of that QE money is creeping into the equities market? Well, Gam, I don't know if it's so much QE as much as just, to some degree, and again, speculating on the reasons behind equities rising is it's always a bit of a guessing game. If you look at mutual fund flows, it's certainly not, the retail investor getting into the game. Perhaps it's just merely the U.S. stock market, by comparison, seen as a haven. Remember, folks, this certainly applies to currencies, but to some extent, maybe in these days, it even applies to some equity markets. One common theme that defines currency moves is currencies are relative. Currencies are relative. I still remember the day when one of our members of boot camp was just baffled with why the British pound would gain strength on a given day or a given week when things were. This person lives in the UK. Things looked horrible there. And the point is, it's not. It isn't just the health of an economy at any given time that affects the currency. Money flow. It's money flow. Money flows where it's best treated, and money can flow on the back of concerns about one major economy. It could flow there based on bond yields, which are affected certainly in part by central bank policy. It can flee because of political turmoil or whatever. There's several reasons behind why money flow into one currency or out of another currency. And perhaps at least part of the reason why equities are so buoyant here, part of it is probably hopes of more easing by the Fed. That could be part of the story. And maybe another part of the story, if you look at U.S. balance sheets, U.S. balance sheets are in pretty good shape. Some concerns about the health of the U.S. consumer, but that's another issue. But another factor is that if for those who are seeking yield, investors who are seeking a riskier places to put their money in an era or in an environment of low yields virtually everywhere, with the exception of perhaps of Australia, then the U.S. equity market perhaps not a bad place to put your money. I'm not trying to advocate investment in U.S. equities. I'm just trying to explain what would be some of the reasons why equities are still buoyant. By the way, let's see if I got this here. Oh, I don't think I have it here. Sorry. I thought I had a chart showing U.S. equities versus the VIX. There's one of our members at FX Bootcamp pointed us to a graphic showing the S&P 500 index versus the VIX, the so-called Wall Street fear gauge. If you notice where the VIX is, the VIX is near historic lows, and I just showed you a little bit ago the S&P 500 index at multi-year highs. It doesn't bode well for a continuation of this recent equity rally. And Johannes, I see your question about beneficial about QE3. I said before, maybe I wasn't explicit enough about it. I don't see a real benefit to QE3. I mean, personally, and again, I got to be careful with that because I try to avoid preoccupying myself with what central banks or political leaders or governments or whatever should do. I'm mostly concerned about not what they will do, but also especially concerned about what the market thinks a central bank or government will do. Now, if I had my druthers, I'd prefer. I like this. The idea is being espoused by the likes of Richard Fisher and some others of the Fed. I think the Fed should be done. I think no more QE, but I'm not in control. All I care about is making money about what from the market's movement on speculation, even wrong speculation about what the Fed will do. And Andy, are you on your comment about the real issue in China? China is like, boy, if there's one situation that's, I mean, it seems like ever since the advent of the financial crisis, there's always been a little something out there somewhere, an issue brewing. I remember, I'm not trying to pat myself on the back about this, but I do remember I delivered a speech at a traders conference in New York City in February 2009. Was talking about the European banks. I said back, this was more than 3 years ago, 3.5 years ago. I said, watch the European banks. They were massively over-levered, and if the economic situation continues to deteriorate, you're going to see they're going to get into a mess. And I didn't know exactly how things would unfold from there, but bailouts by sovereigns happen, and yada yada yada. So, and tell you what, when I talked about that, it was glazed eyes across the board. I mean, everybody looked at me like I was an alien or something like that. What's the big deal with the European banks? Who cares? Blah blah blah. I'm not trying to say I was prophetic there. I said, I just said, hey, there's something to be concerned about that the market at the time, right or wrong, wasn't paying attention to. And so, Andy, in reference to China, China could be that same sort of situation where there could be some serious, some nasty stuff brewing in China that the market's not arguably paying enough attention to. The theory on China, at least one theory about why the markets are behaving the way they are, the same behavior that you're seeing in like stocks in the S&P, or the fact that the euro hasn't just completely tanked against the dollar. It's arguably hope, or bury your head in the sand and just figure that the central banks or governments are going to figure it all out. The hope in the case of China is probably going to be that authorities in China are going to continue to stimulate that economy. I mean, if you've seen, I'm sure maybe you have, Andy, if you've seen the proportion of investment, particularly in the property market in China relative to GDP, it's been grotesque. In fact, China, I'll forget the exact numbers. I usually remember these sort of things, but China experienced a degree of growth in GDP attributed to the property market to a degree greater than what Japan experienced back in the 1980s. And you see what's happened with Japan in the past 20 years. Japan's been, there's constantly references to a lost decade in Japan. It's been more like a lost 2 decades in Japan, depending on how you measure it. Yeah, China's a mess waiting to happen. And what is China dependent upon as far exports? Now, to China's credit, and it's not much credit, but it's worth noting that the powers that be in Beijing have at least expressed a serious intent to rebalance the Chinese economy, away from investment and towards consumption, enabling the Chinese consumer. It just hasn't happened yet. And there was quite the mass exodus in recent months, or actually maybe even earlier, of workers out of the factories in China. I mean, again, I haven't shown you this. Speaking of China, and on this note, I know I'm running past my time, and I apologize for that to everyone at FX Street. Look at this summary. The summary from today's China PMI manufacturing report issued by Market Economics. Output contracting at a PMI contracting at a faster rate. It means overall Chinese manufacturing sector shrinking faster. Look at orders. Orders shrinking at a faster rate. Employment still contracting. Output prices declining at a faster rate. Look at stocks of finished goods. So notice this: orders dropping, stocks of finished goods rising. And we got a political change going on, change of leadership this year, right? Boy, these are interesting times. I don't know if I'm the only one that feels like we're living through some notable economic history here. These are not boring times, folks. Now, I admit there's been plenty of days recently on major pairs like the euro where you're like, come on, euro, throw me a bone here. Do something, euro USD, or do something if you're looking at the dollar yen. But that's common for this time of year for things to slow down, for volatility to diminish in the currency market. Number one. Number two, it's also perhaps a sign the market's waiting for something. Yeah, the Europeans are on vacation. That's certainly part of it too. But perhaps at least part of the equation why some pairs have been stalled out of late, the market waiting for something. What's it waiting for? Well, look at all the question marks. And I'll end with this. What's the Fed going to do? And actually, even before that, what are the Europeans going to do? What's going to happen with Greece? What's going to happen with Spain? Is Spain actually going to agree to a bailout? If so, what's going to be is the ECB going to actually announce a bond buying program? If so, what are the details? Let's face it, the Europeans have tended to underwhelm the market. In fact, it's so many times we've had announcement of a major European initiative followed by almost immediate selling of the euro. Who knows? That could very well be what happens following either Draghi's Jackson Hole speech a week from Saturday, or following the ECB's announcement on the following Thursday. I'm like you. I'm going to be watching to see what Draghi has to say, what the ECB has to offer. We'll figure out from there. So what else was I going to say in terms of what's coming up? Yeah, I think until then, unless we see some unique speculation, some unique, comments, news flow, even rumors. I hate to say it, but even rumors can affect the market. Rumors out of Europe can affect the Euro USD for some other major currency pairs from time to time. But at the moment, here's what I suggest. Pick your battles. There are some trades to be had. The technical still work plenty often in major currency pairs. Pick your battles in terms of trades opportunities. You have other presenters here at Epic Straight who have talked in the past and can talk again in future webinars about applying technical analysis to help your trade planning. But in terms of the major market moving events, I'd say, generally speaking, keep your powder dry. This is not the period of time to destroy or to significantly reduce the level of your account, because we could be facing some notable moves, and not just in the currency market, but in multiple financial markets, beginning, if not late next week, then sometime during the couple weeks after that. Andy, that's true. Actually, Andy, not in terms of the euro's buoyancy. Actually, Andy, I would argue the opposite. Yeah, maybe it's a balance effect. Andy, here's what I mean. Yeah, the S&B and is still defending the 1.20 on the euro Swissy. Where is it? Here we go. Oh, that's not it. Hang on. Andy, there's been reports and seen some evidence, a little bit of evidence of this, that the S&B, or if anything, may be looking to reduce their proportion of euros. This is a breakdown of the S&B's foreign currency investments at the end of the second quarter, and this is an unusually high portion of euros relative to other currencies. So here's the point: there's been some speculation that the S&B on euro rallies will look to sell their euros, to dump some euros in the market, to reduce some of their euro holdings, which they've accumulated in defending 1.20 on the euro Swissy. Now, you also have to ask, what would they do with that? Well, they've at times been dumping euros, and soon after, maybe sometime after, acquiring other currencies. Now, you notice one major currency that's not represented in this list. One major currency not represented. Of course, the Swiss franc isn't shown here, but they don't need that. What one major currency not represented in this list? Yeah, so we have the Aussie, exactly. Was anyone wondering recently why the Aussie was so buoyant? And of course, it was until the past couple of weeks. Now, it's all speculation. There's maybe no real way to prove this, but perhaps one reason why the Aussie's been buoyant of late, and by the way, it's not just the Swiss Central Bank. I've read about several central banks. The Bundesbank in Germany, I think the Russian central bank has talked about this. Several central banks talking about foreign exchange diversification into the Australian dollar. Another reason why the Australian dollar has been buoyant of late, perhaps, in a world of low yields, most major central banks have yields at or near zero rates. If you look at bond yields have been so low. Another standout, I promise I'll end with this. Where's the two-year? I'm looking for a graph of two-year yields. I used to have a graph of two-year yields. What I was going to show is a graph of two-year yields. Oh, here it is. This graph is dated by about 3 weeks, but it does make the total story. If you look at two-year bond yields in relatively safe, highly rated, in some main cases AAA rated economies, the Australian bonds stand out. So in the search for yield, some investors can certainly have been known to park money in Australia. Yeah, it's a carry trade. So Andy, I mean, really throw everything we're both saying together, and you have a case for some medium to longer term bullishness in the Australian dollar. What could spoil that? What could spoil a broad bullish bias in the Aussie? China, at least temporarily. So the big question mark for the Australian dollar is if this is still the soft landing versus hard landing scenario in China. So keep an eye on that. Sorry I ran over time, folks. I hope this presentation has been helpful, and I'm really sorry if I have not seen your question or not addressed your question. Send me an email. Send me an email if you have a question that I didn't answer or didn't answer sufficiently. Please do. Folks, have a great day. Thank you again, Epic Street. Really appreciate being invited back. And again, I apologize for running late. Cheers. Or that is running beyond my normal time. Cheers.